Well, hello everyone and welcome to Momentum channel. Today we're going to be talking about two high quality dividend paying stocks with fast dividend growth in the financial sector. Our first pick is a company called Reinsurance Group of America. It's available with ticker symbol RGA, and it's a financial sector business as indicated on the onset of the video. It has a very safe dividend score of 99 and currently has a dividend yield of 2.57%. The Reinsurance Group of America has a market cap of 8.35 billion, which makes it a mid-cap size business. It was last traded for the price of $124.54. It's worthwhile mentioning that both of the companies that we will review today are considered fast dividend growers. In this case, the Reinsurance Group of America last increased its dividend back in August of 2022 by 9.6%, which is a fast dividend growth. From a volatility perspective, the stocks for RGA has a beta score of 0.87. Beta is a measure of volatility, and a beta of 1 suggests similar levels of volatility to overall stock market. Given that here the beta is at 0.87 or less than 1, it suggests average levels of volatility for this business. For those of you who might not be familiar, Reinsurance Group of America engages in reinsurance business, and it offers individual and group life and health insurance products such as term life, credit life, universal life, whole life, group life and health, joint and last survivor insurance, critical insurance, disability insurance, and a number of other type of insurance. It was founded back in 1973 and is headquartered in Chesterfield, Missouri. Looking at the dividend payout ratio for the RGA, currently they have a payout ratio of 64%, but their forward payout ratio is only at 23%, which is considered very low for insurance. All of that is a good sign, suggesting that this business continues to have a lot of room to pay its dividend and increase it very fast, as it has done it in the past several years. In fact, in the last 5 years, on average, they've increased their dividend annually by 13%. And in the last 20 years, they've increased it by an average of 13% per year as well, both of which suggesting very fast dividend growth. So here you're dealing with a company that has a long history of dividend payments, in fact, 27 years of dividend payment, and it's been increasing its dividend quite rapidly. This business continued to increase its dividend for the past 12 years, year after year, uninterrupted since then. That has had its dividend growth consecutively over times. It does pay its dividend quarterly, and the dividends are paid in the months of March, May, August, and November. In terms of the total annual payout for RGA, it comes to a total of $3.20. It is currently considered to be an undervalued stock, given how the numbers are showing up from its analysis perspective. For one, if you look at their dividend yield of 2.57%, it's about 21% above their own 5-year average of 2.13%. On top of that, their forward price to earnings ratio of 8.8 is well below their own 5-year average of 11, and it's in fact even less than that of the financial sectors of 9.5. All of which pointing out to potentially having a stock that is undervalued. In terms of the past 1 year price range, if you look at it, the last trading price for the stock is hovering a little bit closer to its 52-week high price, which was at $131.65. The lowest that this stock had hit in the past 1 year was at $94.51. We're going to take a look at a number of additional financial measures here. The first one being earnings per share. Ideally, we'd like to see a nice continuous growth year. 2021 was a weird year, and so was 2020. Those are the years of the pandemic as we know about it. That's when the earnings per share for the stock got a hit. But it is showing some signs of recovery. In fact, in the next 12 months, they're estimated to have $14.10 in earnings per share. Next, we're going to take a look at their total sales or revenue. You're noticing here that for the most part, we are seeing that nice steady growth year after year. 2015 was that exception year whereby the total sales had a decline. In the last 12 months, they're showing $16.2 billion in total sales. We're also going to take a look at the number of outstanding shares. We typically like a company that has been buying back its own shares, putting out less shares in the market and giving more value to investors. Here, we are seeing some of that, though, in the years 2020 and 2021, and Afterwards, this business started to kind of have more shares released, and right now at the last 12 months we are seeing 67.8 million outstanding shares. Although that number is increasing compared to about 2 3 years ago, it's still definitely less than that of the past 10 years. Back in 2012 they had about 74.2 million outstanding shares. And lastly, we're going to look at return on equity, which measures how many dollars of profit a company earns for every dollar shareholders have invested in the firm. Ideally, we'd like to see for insurance businesses to be above 10%. This business has hit that threshold for some years, but in many of the years it hasn't. Although it might be a little bit of red flag, but we're going to take a look at a number of additional uh, assessment and analysis to gauge this business better. First, we're going to take a look at the stock overall return. It gives us a good indication of the momentum of the stock, how it's been doing recently, but also we're going to take a look at it longer term. In the 1 year return for the stock, this is based on the data from Seeking Alpha Premium. The 1 year return is showing to be 5% plus. 5 year percent is showing to be down by 4%. However, if you look at the past 10 years, they are up by 107.9, close to 108% cumulative. And if you look at the maximum return, this goes as far back as 30 years. The total return in that time horizon is 329% plus. We're going to also take a look at the assessment by different the groups. This is including Seeking Alpha authors, the Wall Street assessment, and Quant. Quant is one kind of assessment tool used by Seeking Alpha for premium members and professional members, that you get a better gauge of this stock and whether it's a good buy or not, and based on different factor grades. You notice based on quant rating here is actually showing it a strong buy with a gauge of 4.88 based on the measure of from 1 to 5, 5 being a strong buy and 1 being a strong sell. From a factor grade perspective, you're noticing, although for valuation, the stock is considered D, for in terms of the growth, profitability, momentum, and revisions, is all showing currently a very positive signs. And here as well, you're noticing how these measures have changed over time, both in terms of their earnings per share revision, so on and so forth over time. With that, we're going to now look at our next pick. And this is no other than Aflac, another financial sector life and health insurance business with ticker symbol AFL and a very safe dividend score of 99. Aflac has a dividend yield of 2.69%, and it was last traded for the price of $59.40. It last increased its dividend by 21%, suggesting a very fast dividend growth. Aflac has a market cap of $37.5 billion, making it a large cap business, and a low volatility of 0.69 for its beta. Aflac provides supplemental health and life insurance products and operates through two segments, Aflac Japan and Aflac US. It was founded back in 1955 and is based in Columbus, Georgia. From a dividend payout ratio, both current and for its forward payout ratio, they are both showing a low number, 25% for its current payout ratio and 31% for its forward payout ratio. It's worthwhile mentioning that Aflac has been paying and increasing its dividend for the past 39 years straight. They increased their dividend on average 10% for the past 5 years and 14% annualized for the past 20 years, suggesting fast or very fast dividend growth. Aflac does currently pay its dividend on a quarterly basis in the months of March, June, September, and December. Their total annual payout comes to $1.60. They are also showing signs of being undervalued, with their dividend yield about 13% above their own 5-year average, and their forward price to earnings ratio of 11.4 being at the same level as their 5-year average. Although their forward payout ratio, price to earnings ratio, apologies, is actually higher than the financials, it is also indicates that the market and the business overall, the stock market investors are giving this company, given its rapid growth, more value and premium for this business, and are willing to pay a higher premium given how fast this business is growing. And we're going to take a look at a number of those additional measures to see how fast they are in fact growing here. The first one being earnings per share. You're seeing how they're actually nicely increasing their earnings per share all the way until 2021. The last 12 months, they are showing some signs of slowing down, and in the next 12 months, even that. But 2021 was a year that they did really well. Besides that, in the next 12 months, they're showing $5.23 in earnings per share, which is highest in all of the past 10 years, with the exception of 2021, as pointed out. As for their total sales, they are showing some numbers declined, like in 2013, 14, 15, 17, and as well as the last 12 months, their sales has declined. Uh, but they have kind of coupled that with this kind of heavy buyback of their shares from 939 million outstanding shares to now only about 658 million outstanding shares. That's how they're adding more value to their investors. In terms of their return on equity, they've knocked it out of the park for the past 10 years, with hitting that 10% threshold. And in the last 12 months, they're showing that 14% mark. We're going to take a look at it from a Seeking Alpha premium perspective. First, we're starting with the stock return. In the past 1 year, the stock is up by 6%. The past 5 years, they're up by 45.5%. The past 10 years, they're up by 145.9, close to 146%. And if you look at the longer term, going back all as far as back as 30 years, they're up by an incredible 3,009% plus. Just incredible return. And on top of that, looking at the assessment by different groups, although Wall Street has a hold rating, Seeking Alpha authors and quant rating are showing both buy and strong buy. With quant looking at it more closely, showing a very positive perspectives on profitability, momentum, and revisions. For the growth, it's given a C minus, and for valuation, it's given a C minus rating as well. There you have it, folks. A quick look into two high quality stocks in the financial sector that are fast dividend growers and are perfect for dividend investors looking for undervalued options to invest in. I hope you enjoyed this video and gained something of value from it. It is meant for entertainment purposes, so please be sure to do your own research before buying these stocks or any other stock in the stock market for that matter. If you enjoyed this video and gained something of value from it, don't forget to smash that like button and subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing, including investing in dividend stocks, growth stocks, penny stocks, and crypto. We also talk about ways to reach financial freedom. Thank you, and I hope to see you next time.